or suitably upbeat music for Sean Peche, because we have got something pretty groundbreaking to talk about. But before we go there, on this whole story about balanced funds, the conference is only a few weeks away. In fact, not even a month away. And you're going to be here in sunny South Africa. When are you actually traveling?
I'm traveling on the 23rd, Alec. So spending the last few days of August in Cape Town. Well, the 24th or whatever. It's my mum's birthday. So great opportunity to get out there, celebrate with her. Haven't spent birthdays with her for a while. And really looking forward to the conference and meeting all your guests and some of the other fund managers. And as I said, I enjoyed the interview with Cy Jacobs. And looking forward to seeing him. And yeah, so I'm really looking forward to it. It's going to be great.
This is the BizNews Conference. It's in the Drakensberg. Starts at the end of the month, 30th of August. Goes through until the 2nd of September. And you will be telling us all about what? You haven't let the cat out the bag yet. Can you give us just a little taster of what your keynote's going to be, Sean?
Yeah, the keynote is going to be, where are the opportunities today in today's investment environment?
And you'll be looking at it from a global perspective.
From a global perspective, you know, and I think it could be quite interesting. I'm sure people will find it quite different. So I've pretty much prepared it, and I don't want to give away too many secrets, but I've got a few stories lined up. That's the main thing. So yeah, looking forward to it, Alec.
And you're not going to be debating, but it should be real interesting to hear what Cy Jacobs and Piet Viljoen have got to say, or the strips they might be tearing off each other. The one being, like you, a value investor, the other one being much more opportunistic. You said you did enjoy the interview with Cy. I did too, obviously. I had the chance to chat with him in the studio. But something, just as a segue into our next discussion, that came up for both Cy and for Piet was that they believe that size is an anchor to growth. And often that size of funds, when funds get to a certain size, you can't be flexible or nimble enough as a money manager to be able to take advantage of opportunities. Even Warren Buffett says the same thing. He says if he could go back 30, 40 years, he would perform far, far better than he does today because Berkshire Hathaway is much bigger. What's your take on that story?
I completely agree. And Alec, I'll give you a great example. Look, you like an oil tanker versus a speedboat. Okay, the big oil tankers, especially in a concentrated market in South Africa where there's only, I don't know what it is, 50 investable stocks really for the big institutions. You just, you know, and given the weight of money that has moved into passives and the fact that passives most of them are market cap weighted.
What are passives?
A lot of passive funds, ETFs and all the rest, index funds. A lot of the money has gone into the large caps, and the disparity between valuations between large caps and mid caps and small caps is quite stark. Now we've got a small position in Mizuno, and you'd probably be familiar with the golf clubs and sporting equipment. I mean, it's golf has seen a resurgence following COVID. COVID basically saved golf from what I could see. Nike exited golf. Adidas sold TaylorMade. And here you've got Mizuno with their highly regarded irons. Well, Mizuno is only a $500 million company in Japan, and they've got a third of the market cap in cash. And if you strip the cash out, you're paying 4 times earnings. Okay, 4, and they're growing double digits. Last quarter earnings grew double digits because the yen's benefiting them because they're in the sweet spot. Now you're a big institution. You can't buy a $500 million small Japanese company. And so those kind of opportunities are just completely out of the grasp of the large fund managers. And that's how we can add value. That's really how we can add value.
I remember some years ago, Piet Viljoen, when he was very fashionable and very popular, closed off one of his funds because he said that it had got to a size where it was now too big and he could not add value. But that's not a popular approach when you're running a business, as most of these financial institutions are. They look at fund management as a business rather than how much they can deliver to the underlying investors. And I think your analysis that you've shared with me and that you put onto LinkedIn about balanced funds in South Africa really, really supports this. And it's not going to make you popular. But on the other hand, that you're not really in the popularity stakes, Mr. Peche.
Alec, I've said before, all I'm interested in is fairness. I have the luxury of not having, I'm a significant shareholder in our business. No one's going to tell me what I can and can't write. I haven't got lawyers and other shareholders, approving what I can and can't write. I will write what I believe to be true. And if people don't like it and don't want to be friends with me because of that, that's fine. I'll find other friends. I don't think that that's the case, though, and people are welcome to argue and question and debate, and I'd happily debate any of these things. But yeah, I haven't published it on LinkedIn yet, and I think it's I mean, the story. Do you want to talk about that now? Should
I'd like
the background
to. Just as a little aside, I had a similar situation some years ago at MMI. They would invite me to the conferences, and I would do talks there, for which they paid handsomely, as you do with these keynotes, and it helped BizNews through the early stages. But at one of the conferences in Pretoria, I recall saying something that they didn't like. I don't know if it was MMI didn't like, or if the people who were there didn't like, and that was the last invitation I ever had. So you'll be invited to our conferences all the time, but don't expect any of the big asset managers to be opening or throwing down the red carpet for you. But Sean, this is a really, really important subject. Just finally on this, my late father-in-law did an analysis of his funds that he put into. He was one of those kind of engineer, that kind of people, where he looked at what he'd given to Sanlam and Old Mutual, and he discovered that over 20 and 30 years, he actually got back less in nominal terms than the money that he'd put in. So somebody somewhere is making money, and it isn't always the investor.
Yeah, I mean, that's scandalous. That really is scandalous. Well, the backdrop to the story, Alec, is a friend of mine said they wanted to put some money in our fund. They'd read my stuff on LinkedIn. They thought he's an entrepreneur. Thought it kind of chimed with how he thinks about his business and his opportunities. And I said, well, you need to chat to your IFA and make sure it's right for you. I don't give advice. But let me know what fund you're in. What funds you're in. And so he told me. And this fund that I looked at was a fund of funds, and the underlying funds were mostly balanced funds.
What is that, a fund of funds?
So it's a fund where they don't own the underlying shares, they will own a selection of funds.
So they'll charge you for picking unit trusts, in other words.
For picking unit trusts, correct.
And a balanced fund? What's a balanced fund?
And a balanced fund is a mix of global equities, local equities, predominantly local equities. Okay, I mean the typical mix is roughly, call it 50% local equities, 25% offshore equities. Or 25% offshore, and then cash and bonds. And the idea is that it smooths the returns, and people have got a balanced approach. And rather than buying 5 separate funds, you buy one fund and it's all in there. And the return, and because of the smoothed returns, I mean, you can imagine as soon as there's a market crash and there's a photograph on the front page of the Financial Times with some, trader who's got big bags under his eyes with his head in his hands, the clients pick up the phone to the advisor and they go, well, what's going on? How's my money doing? And so these balanced funds have been great for the industry because they've smoothed the volatility and they make life easier for the advisor, and it helps the clients stay the course. Okay, so they've been huge. I mean, 3 of the 5 biggest funds in South Africa today, the unit trusts, according to Bloomberg data, are balanced funds. And so they've been hugely
popular. How big are they, these funds?
Oh, I mean, over 100 billion. I mean, you're around about 100 billion rand. The 3 funds together comprise 320 billion rand. The 3 largest funds.
So it's around
320 billion.
So it's more than 80 billion. 90 billion each one. That's got to be an anchor to performance. But I suppose that's what they're saying to you, is that we balance this so well that actually we protect you on the downside. You won't get the same upside. Have they achieved this?
Well, so the interesting thing is, yes, they are large. Now, remember but in international terms, given that you can take a chunk of your money offshore and given that a portion is in bonds and cash, there should be less of an anchor to performance because you're not just trying to invest 300 billion in the South African stock market where, there's 40 stocks you can buy. So you have the flexibility in terms of the offshore, you have the flexibility in terms of asset allocation, etc. Okay. And so when I looked at these underlying balanced funds, I looked at the fact sheets of the top three. I was quite surprised. Now, of course, from a marketing perspective, the easiest thing to do in the world is you show a client a chart where you've got two lines, you've got your fund and you've got your benchmark. And as long as your fund is above the benchmark, okay, going back to inception, especially if it's a long time ago, the client's fantastic. Sign me up. Because emotionally and just behaviorally, we think that gap in the line and the one line above the next line is going to happen going forward. Okay, bearing in mind that for many of these funds, a lot of their performance, I would argue, and they can correct me if I'm wrong, a lot of their performance came when they were smaller, a bit like. Much of the performance has come in the later years because it's more competitive, it's harder, they're bigger, they're less maneuverable.
But surely the story here is the benchmark. What is the benchmark? If I give you a benchmark of 0, then I'll beat it.
Yeah,
should beat it every time because the economy grows. So is those benchmarks that these balance funds are measuring themselves against? That's got to be the assumption that you investigate.
Well, right, but you can I can choose my benchmark. When I set up my fund, I can choose my benchmark. Oh. Okay, now we happen to have the MSCI World Index, and that's a demanding benchmark because there's 1,700 companies in it. So if I make a mistake and pick a bad stock, chances are that stock is insignificant in the MSCI World Index. Whereas if you don't have Naspers and Naspers goes up, or you do have Naspers and Naspers goes down, and Naspers is 20% of your index, that's an important part. But interestingly, these funds all had different benchmarks. So the one fund had a CPI plus 2%. Okay,
meaning what?
They couldn't. Well, inflation plus 2. So if inflation's 5%, then their benchmark is 7%. And if they earn in rands. Oh. And if they earned, but now they've got money offshore and, rand weakness and all that sort of stuff.
So you're going to be in front there if you've just got money offshore most of the time anyway.
Generally speaking, you would argue, okay. And another fund had their benchmark was the weighted average of how their peers did. But that's quite convenient because, most fund managers underperform. So, if I wish I'd had a benchmark, which is the weighted average of the average global equity fund, it would be a different story. So and then another fund had what I thought was a more reasonable benchmark. Interestingly, that was the fund where their performance line was far closer to the benchmark than any of the others. Okay, so but the point being, you can choose your benchmark, and then all these funds charge performance fees against their chosen benchmark. Okay. Now, performance fees, we could spend a lot of time on performance fees, Alec. In fact, maybe we should do that.
But why, just before you go on, why don't the financial advisors look at this and hold them to account? Because there are two obvious things here that I'm seeing that are jumping out at me. The one is that if you can choose your own benchmark, it's a bit like the marketing guys are actually running. That's the tail that's wagging the dog on the first part. And then on the second thing, we know that the size is an anchor to performance. Warren Buffett says so. Sy Jacobs says so. Piet Viljoen says so. Sean Peche says so. I don't think anybody actually can argue the opposite. It just doesn't make any sense. So if you're a financial advisor, why are you doing this? Why are you putting hundreds of billions of rands of South African public's money into these funds?
So look, not all financial advisors think like this. Okay, otherwise I wouldn't have a fund. Okay, because we have financial advisors. But there's an interesting story that I'm going to tell you, Alec. A few years ago, when I was starting out, I met with a financial advisor who I was hoping would be a client, and he said to me, "Sean, you need to understand something." He says, "If I've got a client who's got 10 million rand, let's say, and I give you 1 million rand, and you do badly, I'm risking not your 1 million rand. I'm risking the whole 10 million rand because he's going to turn around to me and go, 'Who's the Sean guy from Ranmore? Never heard of him.' Okay, and you put me into some, fund that I'd never heard of, and your reputation's gone. I'm taking my whole 10 million rand out. So what do? They want to go with the big trusted names, because if you put the 10 million rand with a big trusted name and they underperform, then the financial advisor meets with the client and he says, "Well, I'm really sorry we underperformed, but I chose those guys and they're really good, and I think we just stay the course." But you can see they're not risking the money. Yeah. It's the psychology thing. And for many, thankfully, not all, as I say, otherwise I wouldn't have some financial advisors support us. But if I were a client and I was out there and I had a financial advisors advising me, I'd say, well, what value are you adding? Don't give me the names of the funds that I could, see every time I open up the newspaper or arrive at the airport or whatever. I want something different. Otherwise, I can fill in those application forms myself.
What about the performance that these balanced funds have achieved, given that they should be there to protect you, that they should be reducing the volatility?
Well, so this is what's interesting, because if you think of the last 10 years, I looked at the last 10 years, and the last 5 years is not much different. It's been great times internationally. You've had the MSCI, has returned 10.7% with dividends reinvested in dollars. Now, I'm going to talk dollars here now, per annum, okay, over the last 10 years. Global bonds did do well, and then with interest rates rising recently, start to finish from 10 years ago, up a little bit, 0.14%. Okay. The JSE Top 40, interestingly, in dollars, has only returned 3.3%, which is quite surprising given how Naspers has done nearly 15% in dollars. Okay. And then local cash in dollars, I just used the return of the largest money market fund, and that's minus 3.5%. So then I look at a benchmark and I said, well, let's say you put 50% in local equities, 25% in offshore equities, 12.5% in local cash and bonds, and 12.5% in global bonds. What would I have got? And I would have got 3.9%, just under 4%. Okay. And then I said, okay, well, what has been the actual experience for these three funds, for the clients of these three funds? 2.2%, 2%, 1%.
So none of them even came close to that very modest benchmark that you put there.
Yeah. No, not even close. And bearing in mind that, you could have had global equities at the right time, and then it took you over the 25%, and you could have, you had lots of asset allocation tools and all this. Not even close. So you go, well, if I could have got 4%, but I only got 2%, what's the difference? And if you look at the total investment charges on these balance funds, on the latest fact sheets, I mean, what are the numbers? It is 1.3%. Sorry, give me 1 second here. 1.3%, 1.9%, 1.9%. So almost 2%.
That's billions of rands. That's if you've got 100 billion rand in your fund and it's 1%, that's 1 billion rand. Those are big, big numbers.
That's right. That's quite right. I mean, those three funds, it's 3 billion rand of fees. Okay. That are charged base and performance, bearing in mind that actually some of your money is offshore, big chunk of your money is offshore. International funds, they're not expensive. You can take your money offshore and, I don't know, put it into passives or put it into, I mean, our TER is less than those. And we run a global equity fund, or total expense ratio, okay? And we're a small fund. I mean, as you remember that as with funds, you have an element of fixed costs and you have management fees, which are variable. So, you've got offshore directors and auditors and legal and all the rest. And whether you $100 million fund or $1 billion fund, you're paying your directors the same fee. Okay, so as you get bigger, your fees should come down as a percentage. They should.
Sure, Sean. This sounds to me like a 320 billion rand ripoff of the South African savings public.
Well, I think people need to look at it. I mean, the interesting thing is that has been the return, Alec, and this is what worries me. This has been the return in good times. We've now got high inflation, rising interest rates, bonds are, falling, apart from yesterday. We've got global instability, and are you in the wrong stocks? So at least you've had some performance out of which you could pay your fees, but the fees have been generous. And as I say, especially when a big chunk of that money is offshore where fees are lower. So what worries me is the clients can choose, but here's the problem. Unfortunately, If clients could tolerate volatility, then they should be in other products. So it comes back to that. Are clients willing to tolerate volatility? Because if you're willing to tolerate volatility, well, then over the long term, you should probably be in the right equities, not the wrong equities. No good being buy and hold of the wrong stuff. You don't want to buy NVIDIA, when it's an $800 billion company and then hold on forever. Or maybe that's a bad example, but, a Rivian or one of those things. Don't buy and hold the wrong stuff, because that strategy won't work. You've got to buy and hold the right stuff.
But especially if you're going to be giving your money to someone who watches this on a day-to-day basis, you have to expect that at the very least they're going to get close to the international index, and that they're not going to be making the billions of rands at your expense. Getting back to my late father-in-law, who would have loved a conversation like this, but it used to frustrate him to high heaven, as you can imagine. I guess there are thousands, if not millions, of South Africans who thinking, well, one day we'll be thinking the same way. They put the money into a fund that was going to reduce the volatility. It was going to give them a good return, but the returns, as you've said, in the good times have been appalling.
Yeah, sadly, that's the truth. Now, some of the smaller balanced funds I looked at have been far better. Okay, and and have in some cases beaten that little benchmark that I came to, and that comes back to the oil tanker speedboat. Do you want to be with the oil tanker, or do you want to be with a speedboat? And what are your best chances of outperforming? And so that's what clients and advisors need to. I would suggest need to think about.
Sean Peche from Ranmore Funds. I'm Alec Hogg from BizNews.com.